Vasu, what have you been telling clients this morning about how to trade the FOMC meeting?
Well, that's a very tough one, Yusuf, because, the jury is still out. Our view is that they're going to hike by 75 basis points this week and probably another 75 basis points in December before they dial down slightly and head towards the 5% terminal rate. So with the inflation rate still running at a fairly high level, I mean, the PCE numbers, the core PCE numbers, which came out last week, we saw it running at, 5.1%, slightly below market expectations, but quite significantly above the previous month, which was 4.9%. So inflation is still a problem. So I don't see how the Fed can, dial down in any big way just yet. I mean, unemployment is still very low. Job market is very tight. And for them to do anything too dramatic just a few days before the jobs data this Friday, which may surprise the markets on the upside, I mean, it may, would be very risky for the Fed to pivot in a big way at this juncture. So our guess is that probably they're going to be 275 basis point hikes, November and December.
Vasu, the folks at Goldman Sachs have put out a note that they're saying they're expecting the Fed to hike more than previously anticipated. They're seeing the rates going up to 5% by March. The market's live team is kind of jumping on this note and asking a broader question. Have risk assets priced for 5% Fed rates?
Well, I think not fully. Not fully. I mean, I think the markets have to some extent priced in inflation, to some extent priced in the 5% rate hike. But the consequence of that 5% rate, or that rate we're talking about here, is that, or perhaps even more, Yusuf, is that the economy could slip into a recession. And I don't think a recession is fully priced in, because I was just looking at the Bloomberg's, analyst forecast for global equities in terms of earnings, and you still see optimism. You've not seen analysts downgrade their earnings in any meaningful way. There's still a lot of optimism. And I think you need to see some kind of a downgrade, some more meaningful downgrades before you can be confident that, 5% rate hike, or rather a 5% rate with a recession has been priced. And I think a recession has not been fully priced in, and that's what worries me.
Mm-hmm. I'm looking at the China data that we got in terms of the PMI, an economy that continues to weaken. The signs are that there are going to be more strains ahead. How contingent is the year-end rally on a China that reopens up, on a China that is able to generate economic momentum again for the world?
Well, I don't think it's going to make that much of a difference. The Fed is still the main game in the markets. It is the main game in the markets. The Chinese economy has not done well. The macro picture in China has been very negative for the last, 18 months, 20 months since February of last year. I mean, the MSCI China index is down more than 60% since 17 Feb 2021. We've had a slew of bad news, and still global equities have done well, and the markets, in 2021 at least, and the markets are very focused on what the Fed is going to do and how inflation is going to play out. So, I think a lot of bad news in China has been discounted. Of course, if China eases up the COVID-19, zero COVID policy, I think that's going to be really fantastic news for the global economies and global stock markets. But it doesn't seem that way. I mean, that's so it could be a silver lining if they ease up on zero COVID.
I mean, the other risk factor is the upcoming midterm elections in the United States. I just want to run you through a soundbite here from Larry Summers, the former Treasury Secretary. Here's what he had to say.
Frankly, the Fed doesn't listen, and if anything, feels more pressure to prove its independence, so they don't influence short-term rates and what the Fed actually does. But they do raise questions in the mind of market participants, and they raise long-term rates.
I mean, Vasu, you were saying the Fed's the only game in town. If that's the case, can the political heat get reflected in some of the Fed's thinking over the next few weeks?
Well, I think, if there's gridlock in the U.S. Congress right now, the Democratic Party has control over Congress, over the Senate, a marginal, majority in the Senate, and, a more sizable majority in the House of Rep. Now, if that changes and we see a gridlock, and, the Democratic Party loses its control over the House of Rep, and we have a divided U.S. Congress, with a Democratic president, historically, that's actually good news for the stock markets. Markets have actually done quite well because we're not going to see anything dramatic coming out of the U.S. government, which leaves the Fed to do its job in fighting inflation and not worry about what the government might do next. Because if the government does anything too aggressive, either way, left or right, that complicates the picture for the Fed. But a gridlock is going to be good news for the markets. That's what the markets tell us historically.
I like investing playbooks because they give you something to work with in times of intense market volatility. You can just look at the script and execute. For clients who are looking at their portfolios, what changes now? What do they need to do?
Well, I think what we are telling clients is, do not be too negative. I mean, you have clients who are sitting on idle cash. They're very worried about the outlook for the markets. Some of them buy on dips and then they see the markets go even lower. And they're worried. I mean, it's understandable. But we're telling them that the markets have come off sharply already, the bond markets and the equity market. So as we discussed earlier, I mean, a lot of that has been priced in. I don't think the recession risk is fully priced in yet. We could see a bit more downside, but it's very hard to catch the bottom. So what we're telling clients is stay invested. Don't buy aggressively, though, but do buy gradually if you're looking to buy on dips, and take a medium-term view. The next 2 to 3 years could be a good time for equities when you buy at such levels. But in the short term, clearly there's going to be volatility. Take somebody with a medium-term horizon, risk appetite, who can see the blue skies. Right now, we're in the middle of a storm, and it's hard to see blue skies. But very often, that's when the best opportunities are.